Good morning, everybody. TJM, and welcome to week 31. Let me also flag that this is going to be the last macro Monday for at least the next 2 Mondays, as KVP will be arbitraging some public holidays that we'll be having here in Singapore. So we won't be back until Monday, the August 19th. So just something to please kind of bear in mind. Obviously, the key thing that it's all about is really all about the Fed, which we're going to spend quite a bit of time on. That's going to be the key thing, and it's really whether it's insurance kind of cut, kind of maybe one and done, or if it's a cascade for more things to come. The way we've been seeing, especially the dollar act, and maybe even yields, you could argue, I mean, they're off their lows. The implication there could be that it is solely kind of insurance cut. I stay very much on the other end, thinking it's very much a cascade to come, despite I will also note that U.S. economic data has been very, very strong. But so far, I have been exceptionally wrong, especially on the U.S. dollar kind of weakening, because we've just kind of gone from strength to strength, and I believe we're basically sitting at kind of all-time, I wouldn't say all-time highs, but year-to-date highs on the likes of the DXY. The DXY is still well south of the highs that it's made kind of in this cycle. As already said, I'll be joined by Raymond Chung out of our Hong Kong office. He's part from the GST Greater China team. Obviously, everything we cover here, solely views and opinions. These not trading, no investment recommendations. So, quick rehash of last week. I will work backwards from volatility. We go kind of the commodities. You could see vol. Here we have a reading from U.S. equities, S&P. This here is from the DAX. Vol very much kind of compressed. Big part of it coming kind of to Friday. It was another one of those days where a lot of big moves happened on Friday. Some of it was better than expected. GDP that came out of the U.S., I believe 2.1 versus 1.8. That was the initial reading for second quarter. For the week, vol was down about 16% on VIX, and then we also have bond collapsing in regards to the bond market as well. And here you can see what it's all about 90 basis points uplift, key level on DXY. If you recall, it was 96 to the downside, 97 to the upside, and here we're closing at 98 as of kind of last week. And there was a lot of obviously contention, really a euro and kind of a yen story, but dollar pretty much, huge kind of gains across a lot of the other kind of crosses from Naki, likes of Seki, and even stuff like ZAR, which had been holding up very, very, very well up until just kind of 1 or kind of 2 weeks ago. Equities predominantly green, especially in the Eurozone and the US. Big move on equities on Friday in tech. Big beat by Google, as well as an announcement of a $25 billion share buyback. That sounds impressive, but it's actually only about 3% of their market cap. But still, the S&P kind of like that. For anyone who bought Google 2-week kind of calls, I think they're actually 3-week calls at the money. Yes, on Thursday, you'd have made about 10 to 15x your money if you had anticipated that kind of earnings beat. Commodities was a little bit mixed, not as kind of clear picture. We did continue to see this outperformance on silver versus gold, as we've said kind of in last week's, and also looking from those multi-year, multi-week charts. The breakout that gold is experiencing is still being lagged by silver, despite the 1.24% by silver last week and the previous weeks of 6.4%. If you have to again go back and recall that the highs in silver in just 2018 were about 1770, so we're not yet breaking out to multi-year levels on silver, and I still think that will kind of come through. FX, I think we already kind of discussed. DXY now up about 123 basis points in the last 2 weeks, circa 200 basis points in July so far, as we just kind of come down to the last few days of the month. Fixed income, again, predominantly tighter across the developed markets, a little bit mixed once you start to get into kind of the EM as a whole. And I think econ, we had flash PMIs last week. The theme I really saw was more of misses, more of, again, this kind of lower kind of growth, no real kind of bottoming out, so to speak. And we still continue to see the trend of the U.S. posting generally better economic data versus the rest of the world. Very strong durable goods. And as I said, this better than expected GDP kind of reading. Going back on a few other things, this is predominantly MEA and Europe. UK Boris is in. Interestingly enough, sterling was still kind of taking a beating off of kind of the back of that, making kind of new 2-year kind of lows on the likes of cable at these kind of 123.84 levels. I thought we were actually trying to kind of bottom out, but again, still not yet there. Interestingly, we'd flagged this on Macro Monday last week, the chance of a much, much bigger cut coming from the Central Bank Reserve of Turkey. That's exactly what happened. They cut by about 425, down from about 24% to this 1975%. Interestingly enough, TRI was not too changed actually for kind of the period kind of going into it. And the big day last week was really all about ECB, where there was a contingent of the market expecting them to potentially do something. They didn't. In my viewpoint, I just don't think Draghi was that dovish. You look at the press conference, some of the things he's talking about, recession risk for Europe are still low. It did not seem too overly kind of concerned, to me at least. But I think it's also this question of just consensus amongst the ECB kind of constituents, because that's, I think, the main thing that people kind of forget. Northern and Southern Europe, very, very kind of different. But he basically indicated that September is when they would be moving. It may not necessarily be a rate cut. It's more likely going to be in regards to kind of maybe purchases that they'd be doing on kind of the bond market. Quite a big intraday kind of move session on the likes of, let's say, bonds, European rates, euro dollar. Yet at the end of the day, we still closed lower than from, let's say, 2 Fridays back. So overall, there seems to kind of be this lack of kind of focus. I continue to have a bias towards euro dollar going up higher. That was what I was advocating with people and clients as I was speaking to on kind of Thursday. I think we could easily rise from this 111.36 levels to 112 easy, and then kind of 112 and a half, 113 kind of being kind of the heavy lifting, the heavy work. But again, I've also been very surprised at this kind of continued US dollar strength that we've been kind of having going into kind of the Fed. So with that, just a quick look at kind of US earnings so far. This is kind of how many have reported, so close to almost half of the S&P. This is going to be the earnings growth that we're seeing so far, so about 4.2%. Sales kind of about the same as usual. We tend to see stuff like telecommunications, which is where some of the old school tech names are, continue to kind of beat. Interestingly enough, we are seeing healthcare and the actual tech not doing so well, but early days you can only see about 17 of 51 have actually kind of reported there. And basic materials continues to kind of eat dirt with about half of that kind of reported. And this is maybe interesting in the sense of it's tying kind of back to maybe what manufacturing is kind of looking like in the US. So just food kind of for thought there. Next slide really, and you can kind of go back. The bottom here also shows kind of the trend to give you some context. So this is kind of the quarter whose earnings reporting we're in right now. This is earnings, and this is sales, obviously, for all the sectors, so to speak. So it gives you some context of where we were Q1, and you can actually see that earnings so far and sales so far are above kind of Q1, right? So it'll be interesting, and of course these should be kind of forecasts. The next slide really is just showing you more the surprises on both sales and earnings. And you can actually see that surprises are pretty kind of decent. I mean, this is always kind of a little bit, what's the term, sand kind of washed in essence, or sandbagged. Like it's a game that analysts kind of play. We always do seem to have earnings surprises for whatever kind of reason. I think off the top of my head it was something like 2/3 always seem to kind of beat, but still interesting and nevertheless to see a little bit of kind of the trend of where it's happening. Again, basic materials, being kind of on the tail end, but funnily enough, so far in the tech as reported, quite positive kind of there. Again, here the context of where we kind of are versus where we've kind of been. So again, from an earnings surprise perspective, so far at least, not too bad compared to, let's say, Q1 19, and well above kind of Q4 kind of 18. So, but again, we still have a little bit over half to kind of go. So just giving you a little bit of context, spend a little bit more time on kind of the deck. Just on the cut, at least from my side, not too much change in overall US dollar kind of positioning. We've seen some of the same trends we were seeing last week, longs increasing in CAD, as well as the real, so to speak. I think on the real, it could have a really, really big run. There's also some debate on whether the Brazilian central bank will be cutting by 25 or 50 basis points kind of this week. we should potentially see an inflow into kind of that bond market and assets kind of there. And we continue to see shorts on the sides of Kiwi, Aussie, Euro, and the yen as well. From a commodities kind of perspective, we had a big kind of reduction in overall positioning of about a kind of a quarter from that. And going on to kind of the week ahead, there's really, really a lot on. So I'm going to touch on two more slides, and then I'll pass it over to Raymond. So there's a lot on. Really, it's mainly about kind of the Fed, at least from a global macro kind of perspective in regards to it's 100% probability that they're going to be cutting. Let me say that. It's 100% probability they're going to be cutting. It's about an 80% probability that it's a 25 basis point cut, and there's a contingent that says 20% that it's a 50 basis point cut. That has flip-flopped around over the last few weeks, and that's also why it's been very, very hard to trade FX rates and even some of the commodities, just because of this kind of turning around and where expectations are, and even the Fed having to clarify that comments said by, I believe it was Williams, are not to be kind of construed in regards to the decision that they will kind of make. So I think it's going to be very, very debated. There are still definitely some houses out there that are expecting 50 basis point cut. I think the more interesting thing is they'll definitely cut by 25. I would be surprised by 50, but no one really too much, in my view at least, seems to be talking about maybe them ending quantitative tapering early. So that was originally scheduled to end at the end of the third quarter. So the question, though, is how is that interpreted? Is that interpreted as kind of dovish, or is it not? We do know U.S. economic data has been fairly strong. We also do know that, once again, we are going back to this focus of potential U.S.-China trade talks, moving on to kind of the next level. We're going back to face-to-face talks, which should be resuming today in Beijing. It's my understanding these are the first since kind of May. So there's quite a few other things that are, you could say, kind of constructive in essence. Final PMIs are, again, going to be key on the manufacturing side. We'll get the services next week. We also have, of course, US ISM manufacturing. It is worth noting that last week we got on the market PMI manufacturing from the US right on that kind of 50-point level. So, below 50, we're contracting. Above 50, we are growing. More importantly, I think, is going to be, at least for us out here in Asia, the official PMIs from China, both services and manufacturing. Then we also have the KAIX and manufacturing coming through. It'll be interesting to see if we're seeing some kind of divergence there. As Forrest was outlining last week, the last batch of monthly data we got from China were very, very strong in regards to kind of the beats across. And then, of course, outside of the Fed, we have BOE. No real kind of view there. They may just keep their optionality, depending that we're getting to a countdown of October 31st and Brexit, and of course, as I said, on Brazil is where there's 25 or 50. Again, I just outlined the next week, so not this week's kind of rate decisions, potential to watch out for RBN. RBNs that are going to be heavily contested, as I think RBI, everyone's just assuming it's a cut. Bank of Thailand, again, will be debatable, and Philippines could also see that same kind of skew. There are no Fed speakers scheduled as at least of the weekend, but you never know once they actually do finally make a kind of a decision off of that. Worth noticing this other kind of floating potential event. I'm not saying it's this week, but it could be something that's playing out towards maybe the continue of this third quarter. And this is this potential sanctions risk for Turkey, where it seems that maybe potentially, at least through the lines of what we've heard from Erdogan, Trump is promised that he will not put sanctions, or at least that's what he's indicated. But at the same time, there's actually legislation that he has signed, in essence saying, if you're a member of NATO and you're going out and you're buying military tech from Russia, then you can also expect sanctions to kind of come through. So we do know that I believe the Department of Defense there is advocating that. There's also members of kind of the Senate. So this to me is just definitely a very, very big key risk. Hard to say really kind of on timing. And hard to say how much is priced in. I don't think anything's kind of priced in. If anything, the lira has just been doing very, very well, given the fact that that central bank governor was sacked. We've closed that gap up, and we just had better than expected kind of rate cuts, so to speak. Even though maybe the market was a bit surprised that the central central bank still indicated that potentially they'll be a little bit more kind of cautious. So again, very, very heavy econ week. Watch out also for quarterly CPI out of Australia, 1.5, always a big mover for the Aussie out here, and then maybe retail sales telling us something about that kind of consumer discretionary kind of spending as a whole. So one last slide before Raymond. So this is kind of the key one that I've had since 20th of June. The whole premise of this was this kind of potential regime that we're going for. Been fabulously wrong so far in regards to kind of a weaker USD, whether it was team divergent or whether it was kind of EMFX. Just generally kind of speaking, I'm sure there's potentially some exceptions such as MXN, BRL, and so on. But just generally speaking, especially against kind of the euro and the yen, and I think it's just maybe something I was just not fully kind of factoring in regards to kind of the speed. But again, this is a very, very long, big picture kind of view, given kind of the cutting cycle. And we look at a few charts there. One thing that is definitely continuing to do very well is high yield, and of course this precious metals breakout that we've seen, which has been completely kind of on fire. And with that, let's move on to the next two slides, which will be taken over by Raymond, please. Thank you. Right?
Hi, good morning. Hi, everyone. For today, I'll be talking about the Starboard, which has caught quite a lot of attention from last week. For Starboard, it's actually a non-main board listing on Shanghai Stock Exchange for science and technology companies. It is kind of known as the Chinese version of the Nasdaq, but then I try not to put too much linkage or references to the US or other overseas market because, as everyone knows, for China, they are adopting a very different mindset and with a different purpose or focus whenever they roll out a new listing or trading regime. For this board, it's actually set up to encourage the growth for technology companies that can simultaneously meet the national strategy with a breakthrough advancement in core technology. So this is you can kind of understood it as a venue for companies that has a new core competence in developing technology patent or products which can also feed into the national development directives. So for the companies listed on this board, they are mostly about new generation information technology, also with high-end product equipment, new materials, energy, and energy conservation, and also for environmental protection, which has also been a very frequently mentioned topics in China throughout the year of 2019. And of course, biomedicine is something that we cannot miss out on this new technology development thing. Another thing that we would want to understand is most of these companies are leveraging heavily on internet and big data. AI, cloud computing has always been a core development focus for China. So this is one of the key platform or stage where the China government can establish a new battleground for new companies who has a relative competence in this area. Okay, let me go to the next slide. Okay, so there are a few facts that I want to cover for the Starboard. First of all, they have a much more relaxed daily limit as opposed to the main board listing, which has a 10% max up or down every day. So for Starboard, there is no daily limit for the first 5 trading days for every new list companies, and thereafter the limit will be 20% up or down, which is more like a double of what we are seeing from the main board listings. The good thing about this new daily limit is that it can provide a higher volatility and also a high efficiency, which is always what the investor or trader would seek when they trade in the equities market. The second thing, it's about the order price limit. When the trader or when an investor try to put in a limit order on the Starboard, they have always to abide with a limit price within the 2% of the prevailing bid and ask level. With this 2% lockup, it can prevent the trader from getting abrupt price movement or even accidental fat finger occasions. So this is another protection mechanism that the Shanghai Stock Exchange is trying to implement to help trader with protecting their trading interest. For the third thing, it's about the new circuit breaker. As we know that for A-shares in China, there has always been a circuit breaker in place. But for Starboard, the circuit breaker is much more higher. The threshold is currently setting at 30% and 60%. So whenever a stock reaches changes in price value for 30%, it will kick in the circuit breaker for the first time, whereby it will suspend the trading for 10 minutes, which is also relatively shorter than the other main board listing occasion. And if the trading continue in such a volatile manner, it could potentially reach up to 60%, and then it will initiate another circuit breaker or another trading suspension. So with this much more relaxed circuit breaker threshold, the benefit is that we will be seeing less frequent trading suspension during the market hours, and also better trading continuity, which can sort of give the trader a better momentum when they want to track the pricing and the trading mechanics on the market. One thing that I would want to mention here is that in contrast to the main board listing shares, for the starboard companies, when they are suspended due to the circuit breaker mechanism, during the 10 minutes blackout period, trader can still put in their order, be it a cancel order or a new order. The exchange would still be accepting these new instructions during the blackout period. When the blackout finishes, the exchange would run a price matching mechanism to determine the best price to begin again for the remainder of the trading session. One last thing I want to mention is that there is a protective price limit for the market orders. When you say market orders, a lot of traders are getting used to the sense that they are buying into the whatever offering price that they have, or they are selling at whatever bid price that they have. But with this mechanism, all market orders would have to provide a relative protective price limit, so that when there is a thinning liquidity on the market, the abrupt price movement will not significantly harm the trader's execution performance, which is one key advantage over the main board listing. So for starboard companies, it is currently only traded on the domestic market. It is not yet available on the Stock Connect. But there are talks on the market that this part of the exercise is being reviewed and being done right now. So speculation is that all these starboard members will probably start to trade in Stock Connect within a very, very soon time frame. So with that I have shared, I will be passing off my sharing back to Kay. Thank you.
All right, thank you, Raymond. So just a few kind of quick charts that we'll kind of go through. Again, most of them are big kind of picture. So here you're just showing just the undisputed kind of US dollar kind of strength. DXY obviously heavily kind of weighted towards the yen and the euro, but even the broader kind of dollar index is still kind of showing the same thing. So these are weekly, and you can see just consecutive kind of weekly kind of closes above 200, just failing to kind of break down low through that, which is quite interesting, especially when you consider that already from early Jan, Fed was indicating that they had stopped, and then we already started to get wind of them moving towards kind of a cut. But again, it's a relative world, and it could just be that just missing something. My interpretation of seeing a dollar this strong is one of two things. It's either the world kind of anticipating some kind of global recession, in which case kind of the U.S. is kind of bid, but the U.S. data seems to indicate that is just generally not the case, or it could be just the fact that people still think that at the end of the day the U.S. is going to be attracting kind of more assets given its high yields, given its kind of stronger kind of equity markets and so on. Wouldn't say that that's what you've been seeing in bond flows in essence, because the yields are higher, so that doesn't quite work out. But we are definitely seeing equities continue to make new highs in the U.S. with a new high done by the S&P just on Friday, right? So food kind of for thought here. Again, indicators still very kind of constructive and bullish. I was actually expecting us to turn around post the ECB, but we'll need definitely the euro to do a much kind of better job. So this here is since 83. The yellow gold line, whatever you want to call it, is basically the Fed rate in regards to kind of the upper range. So we're sitting at kind of 2.5, obviously moving up, they're hiking, moving down, they're cutting. And this is the broader kind of based US dollar kind of index. So you can definitely see off of the back of this that there is a trend for it to kind of follow. I think that's kind of pretty clear. But of course, there definitely does seem to also be a lag, right? And it's not always so kind of clear cut. So maybe that's potentially what we're kind of going through right now. Again, we'll have to kind of wait and see how the rest of kind of the year plays off. But here we're going to basically move down to 225. Some people may even think 2, or maybe 2 by the end of the year. But we're seeing actually the DXY kind of break out the other way. What we could also be seeing here is, again, the same thing. Let me see if I actually had a cleaner one. Okay, we don't. So this here is showing you the same kind of cycle on the Fed cutting rates. And this here is gold, right, as a whole. What I've tried to do with these lines here is the first line kind of illustrates when a cut is made. Second line illustrates when a hike is made. So basically trying to take, a cutting cycle and just taking a slice of that. These are kind of monthly, so it's more just, to kind of eyeball and get a sense. And what it's basically showing is every time that the Fed has started to cut to at least the next first hike, we've tended to have a rally in gold. So in the 80s, about 32% kind of rise, not even from the lows, but from the actual initial kind of first cut. In the early 90s, about 15%. Do bear in mind that some of the equity names, they have a lot more kind of leverage towards kind of gold spot. So some of them may actually be posting double, maybe even triple these, so to speak. In early 2000s, a lot more kind of an explosive move upwards. We were also obviously going through a bit of a recession in that kind of period, about 172% on gold. And in this kind of period here from, I guess you could say GFC, when we started to kind of cut rates, to the first hike in December 2015, believe it or not, gold was actually up 82% over that period. The high at that time was about, call it 240 kind of percent. So this could kind of be interesting to see what this kind of next leg up higher means for gold, especially as we're about to start kind of cutting down. I guess in a long and short way, it's another way of saying very, very much comfortable in the massive kind of upside that's still left to kind of come in the precious metals as a whole. For those of you that don't like kind of the near-term kind of volatility, you can always pick out stuff that's 1 or 2 year kind of call options, or if you feel that you've kind of missed the boat. I still continue to like kind of silver on this, but again, it does not have to be exclusive, right? And of course, there is also ETFs that also give you some dividend. This is kind of the same thing with graphed up against kind of silver as well. So that should pretty much kind of echo what we've seen in gold. This here's a weekly chart on silver, showing it again, kind of the big kind of close on the 200 kind of week moving average. So that's pretty kind of pivotal. And it's now really about taking out that kind of, I believe, 1770 highs that was set in kind of 2018. And even then, we're still not multi-year kind of chart kind of breakaway, right? Just on this chart going back to 2016, you can see it's 21 before we start to get to kind of levels that are similar to kind of gold, i.e. massive still convexity of the upside on silver compared to kind of gold. But I would not be, trading kind of the ratio. Same thing here again, Fed rate hikes and cuts over the cycle from 83. You can basically see that this is U.S. 10-year yields steadily kind of going down, as we know, and definitely seems to be a little bit more, as you can see kind of from the rise here from the December hike, we basically had this big kind of move up in yields, and then we kind of ran into kind of fourth quarter kind of 2018 as a whole, and now we've kind of been reversing kind of in anticipation of a cut, or at the very least maybe kind of a pause, so to speak. So definitely kind of a relationship there. I should note on all of these charts, you can see there's quite a bit of a significant lag. So this is definitely not for the fast part of the portfolio to kind of play these trends. This is a lot more for the medium, long-term investors, if you will, or traders who just have an ability to structure part of their book to be able to kind of take long-term kind of plays, right? So this is definitely something to kind of take into kind of account. Again, same thing, but now we are looking at kind of S&P. What this definitely shows, at least in early 2000 and mid kind of 2000s, is when we're starting to have a Fed cuts, that actually also equated with equities kind of selling off. I think the key thing to bear in mind is, of course, that this was also going through a recession in both of these kind of periods, and that doesn't seem to be the case kind of now, but still food for thought. Worth noting here, through the cuts here, we pretty much still had a bull market, it looks like, in kind of the late 80s, maybe a little bit of a bear market in a period there kind of in 90, but nothing too crazy or onerous. So these are supposed to just kind of give you a little bit more kind of context. This here is emerging market equities, just to give you a little bit more, again, context. I could only go back to 2003 from when the ETF has been kind of trading. A little bit more of kind of a mixed picture here, again, given just that kind of cycle when we did have kind of this recession in the U.S., kind of global, so to speak. Amazing, though, to see just how quickly EM bounces post a crisis, right? And that also coincided with the U.S. dollar getting a lot kind of weaker. And this here goes back to weekly on Euro, still bearish, MACD crossing down lower, RSI still kind of trending kind of lower. 113.5 is that key level that we just, for whatever reason, could not kind of close above. It is worth bearing in mind September 12th is the next ECB. That's miles away in this world. This here is the daily on the euro, and it does look like potentially we are trying to kind of bottom out. Not yet turning on the indicators, but could kind of suggest that if we don't break the lows that we've set over the last three kind of sessions. I believe we were about maybe 111.02 or something like that from last kind of Thursday. And this here is Bunds, showing you just like how massively we are. Also same thing kind of euro. Potentially maybe you've just seen a near-term kind of bottoming out in bond yields, and maybe we kind of move back to kind of closer to kind of minus 30 basis points before we kind of go into kind of next kind of September 12th ECB. And again, we'll be back on, August the 19th. I'm going to be arbing some holidays that we have here. So happy early National Day and happy Hari Raya Day as well. That will be coming up in kind of early August. And wishing everyone a very profitable close, not just a month, but obviously brilliant start towards August as a whole. And now let me just kind of close off the recording, and then we can bring back to kind of some Q&A and some kind of positioning and other trade views that we did not necessarily